to take an example of co-lending, I think it's a win-win situation for both. Give you an example of this, I think I understand we are the only player currently to work with an unsecured lending partner as well as a secured partner, and just because we are there first, we've seen a 30% uptick in business in the first 2 months.
What are your thoughts about the way we collect some of the digital loans and some of the new age loans that we are distributing in the market today? Is there a change in collection strategy around them?
When we implemented these multiple scorecards across the collection stages, we are seeing a great uplift along with cost control.
One final advice to young bankers or young fintech players who are probably starting the companies, fintech starting their businesses today, right, in this space. What advice will you give them so that they can learn from some of the learnings that you may have? Welcome to the Credit Continuum by Yubi. It's a place where we discuss with industry leaders what's happening beneath the surface, the tectonic shifts that are happening in the industry today, which end up shaping and making into headlines which we read on a daily basis. I am Vipul Mahajan, Chief Business Officer at Yubi. At Yubi, we work on a daily basis with leading financial institutions of the country to help them power scalable credit ecosystem. And we work across the credit lifecycle of any lending institution, be it the onboarding, underwriting, collections, and various different stages at that point of time. Every day, our lives are getting impacted with the speed in which the retail industry, both from liabilities and assets standpoint, is shaping and changing the way the entire banking and NBFC industry operate. To help us unpack the responsible retail lending, I'm delighted to have Mr. Sumit Bali, Country Head Retail Assets and Debt Management at Yes Bank, have joined us for the podcast today. Welcome, Sumit.
Thank you for inviting me.
Looking forward to a fantastic conversation today. So let me start, Sumit, with asking you a bit about yourself, saying that you've spent about 3 decades in the industry across various different roles, across various different profiles over a period of time. What brought you into the industry, right? What was the trigger to be able to join this industry and continue to scale at different heights? And if may I also add one more question to it, what has stayed the same from when you started in this industry, to your surprise, has continued to stay the same? And what has changed dramatically now, from then to now? What are the things that probably have changed humongously?
Yeah, so I've been in retail financial services for over 3 decades now. So after I graduated, for 2 years I was with a FMCG company, 2 years with a paint company, but that's the time, and this is 1994, when NBFCs were in great vogue, and a lot of them had set up shop, and that's when I took a decision to move to Kotak Mahindra. That time, Kotak Mahindra Finance Limited. I think financial services always interested me. I was always good with numbers, and I like to see what is happening in the market or what is happening around us. And to see retail lending firsthand gives you a glimpse of what is happening around you in terms of society development, etc. So, 94 I joined, and since then, it's a different world altogether. I remember those times it was hard checks. You had to cut a physical check, pay the dealer, or make some bookings, or send transfer money request 2 days in advance to head office. Those were the days of floppy disks and drives, where every end of the month you had to send a floppy disk to HO for whatever happened during the month. So all that has hugely changed. And that time it was very paper-based back decision making. So you had to have financials which were of your past year, and then basis that you took a call on the lending or not lending to a customer. So today technology has reshaped it. Information is much more easily available. Bureaus have made a huge difference. Technology means transfer is instant. Decision making is on the go. So it's a massive change, but the fundamentals of the business in terms of lending, a successful retail lending franchise remains the same, which is that you have to focus on three variables, which is the margin, the volume, and the risk. Think of it like a triangle. I mean, you have to ensure that it's a proper triangle, and at any point in time, you should be absolutely aware what your risk is, and then adjust the margin and volumes. So that is something which has stayed through and through, despite the changes in technology. But that remains the underpinning of a successful financial franchise.
No, I love the triangle that you pointed out, right?
Mm.
Margin, volume, and risk. Right? These three are foundation to any asset class you look at, any channel of lending you look at, any type of lending organization, whether you look at bank or an NBFC, whichever scale or size.
Right.
I think absolutely right. You get these right and you are home. And to your point, where we have come long way, I'll share one of my example too. When I started my career in HDFC Bank, so I started in analytics, one of my first projects was to predict bounces in a two-wheeler case, because the two-wheeler was given in deeper geography.
Right.
Back then, if the check is presented and the check is of a tier 4 city, by the time you'll get the bounce status, it'll be 25th of the month.
Yeah.
Just to get to know. Right? So that happened to be one of my first projects. I think we have come as a journey in a long way.
Yeah.
Coming to now to Yes Bank, with your mandate as country head of retail assets and debt management, how are you thinking about it? That which are the key levers that you would like to probably drive and shape for Yes Bank and for the industry, that as we step into the next wave of doing things in the industry, what are your takes on that?
So, today the information available about a customer or a prospective customer is immense. I mean, at a click of button, you can know about his bureau history, his repayment history, the loans he's carrying, the income he has, the outflow he has, and you also have access to some social variables which can help you decide about whether to lend to a customer or no. And in addition to that, a lot of scorecards are available, availability of banking statement through a click, etc. A lot is now available. But to continue to build in today's environment, I think technology plays a key role. If I have to outline, I would say technology is central to the lending business or any banking business. At the same time, analytics and risk management. I think these are very critical to build a good franchise today. And given the way margins have been coming down, I think all these three, you have to be collectively excelling in to ensure that you run a very good franchise.
No, I think absolutely right. And I will take your point in three different buckets. Scaling the business, technology being at the foundation of it, and managing risk.
Yeah.
Right. And if I would like to get on each one of them step by step, and starting with risk first, right? Given bank is very sharply focused on risk reward based, right? Pricing and risk reward based, the entire business is constructed. How are you thinking about managing risk in the current scheme of things when the loans are moving at a very rapid pace? The loans are going out in much faster time. The decisioning is very data driven. The entire processes have shifted very digitally, technology, and now going forward AI based. How the entire risk framework is expected to play out in this?
See, a lot of it is very dynamic now. You have to be extremely dynamic in terms of ability to manage risk. Decision making has to be quick because that is the way industry is moving. As I said, information is available, but what do you do with that information? What kind of scorecards you build? That is the secret sauce. So that is something which we work a lot on. And when you talk of technology, you also have to be aware that there's no gaps. There's no gaps in the sense there's no one who could come and plant a virus or anything. So you have to be very careful that the firewalls are good, technology is preventing any kind of misuse of that. And using that, then there's a huge amount of data available to be able to sift through all the data points and fit it into a scorecard is extremely critical. Now, there are various software companies available in terms of loan origination system, loan management system, and every journey is becoming digital. And that's not no longer it's an innovation, it's the requirement of the industry. So to get that whole journey right, which means customer convenience right, scalable technology works 24/7, using the analytics scorecard, all the variables woven into one proper scorecard, ability to assess the separate segment of customers, that's very critical. And then using technology even in collection. When I talk of collection, I mean, today we have about 10 plus scorecards only on collection, right? From pre-due management to bucket allocation to quicker allocation.
And this single asset class.
I mean, this is across all asset classes.
I mean, 10 scorecards in one asset class across the life cycle.
10 scorecards would be available for collection as a function for all the scorecards. So you have ability using past data to see which customer is likely to default, which customer responds if you reach out to him 3 days in advance, which customer requires a call, which customer requires a follow-up visit after a call. All that is available. So it makes you far more efficient, more in control of your costs, and of course better delinquency.
No, absolutely. I think the industry pivoting towards heavily analytical and scorecard driven, especially in collections and in the entire risk management, is baseline today. Right? How fine and how refined and how deep, I think, is where Yes Bank has excelled to be able to do it really, really well in that space. But your point on customer experience gives me a segue into the next question. Building scalable businesses while making sure that the NPS with the customer stays very, very high, the experience is unparalleled. How are we doing about that, and how are we looking at that, saying that in the new age, in the new set of customers that we are touching every day, they are seeing credit in a very different shape and form than when probably you and I started our careers into. Right? Their expectations are very different. Then how is the bank and how are you thinking of pivoting to be able to satisfying those expectations?
No, so you're very right. I think the customer expectations and the outlook to credit has changed. I think during our generation, as I often say, we were more about owning an asset. These days, I think the younger generation is more about renting or experiencing an asset and ensuring that their cash flow meets the outflow. It's not owning an asset for 5-6 years. So that's all gone. So at the same time, they're very savvy with technology. So for them, the ease, as one put it, that they would want something 24/7 and the least number of clicks. So you have to be able to provide that kind of facility and service, and therefore your technology architecture, decision making has to be 24/7, which is essentially, it brings you to the use of AI and ML in the whole ecosystem. So that way, that's where it is. And we've seen customers who are to an extent even immune to rate of interest as long as speed is available to them. If they need money in next 15 minutes, if you provide that, they'll be a bit more immune to the rate of interest you charge. So all this is how you're using technology, AI, ML, and also meeting the aspirations of the customer. And at the same time, as technology progresses, the whole industry of fraud also progresses equally. There are equally smart people working on it. So you have to continue to stay in a state where your technology is not getting disrupted.
No, totally agree with you. I like your analogy of owning an asset versus renting. I think that's the tectonic shift beneath, and hence the credit form factor also needs to change according to that. Right? I will change the nature of our conversation slightly to partnerships lending. That how you are looking at partnerships lending as one of the channel for your overall portfolio, and we can deep dive slightly more on co-lending or digital lending partnerships, right? How you and the bank is thinking about the same to be able to use that as a channel for a core business strategy?
Yeah, so see, it's extremely critical for a young bank like us. I mean, we don't have the legacy database of customers which others would have. At the same time, being a challenger bank and being a relatively later entrant also means we have the best technology stack in the market. So today, what is happening is that a lot of NBFCs, a lot of fintechs own a customer. They have a customer whom they are engaged with, and they also have a lot of data about that set of customers. Bank have the advantage of funding cost, lower cost of deposit, etc. So having access to that data of a partner with our ability to lend at an affordable rate, and with the information available with the fintech or an NBFC, and to take an example of co-lending, I think it's a win-win situation for both, because NBFCs, fintechs have far more data, they have far better reach than banks like us. So using technology, if we can access that set of customer to give loans, to be able to collect using the partner, etc., it's a win-win combination. And that's where technology plays a role, and that's where it is very critical for a challenger bank like us to have these partnerships. Now, to give you an example of this, I think along with the Yubi only, now we had these new guidelines of co-lending. We ensured we went live in the month of January when the new guidelines kicked in. I understand we are the only player currently to work with an unsecured lending partner as well as a secured partner. And just because we are there first, we've seen a 30% uptick in business in the first 2 months. So that's how critical technology, partnerships, and reach of the partner along with the strengths of the bank comes together and makes a win-win situation for both of us in this ecosystem.
No, you're right. Using the bank's tech infra and the balance sheet muscle, extending that to the last mile customer through the NBFCs or the digital partners, right? Obviously via the tech stack of UB and someone in the middle to be able to help you out. But my compliments to both Yes Bank and UB team of making sure both secured and unsecured, we are through and CLA compliant and scaling business really well across.
Yeah, I think it was a great partnership. A lot of ups and downs, but a lot of late nights. But at the end of the day, very satisfying to see both
very satisfying
journeys.
They're
being
all worth it.
Live, yeah.
From technology, let's move into the space which you were just speaking before the start of AI, right? How AI is going to shape the industry is a very wide topic getting discussed today. I will slightly narrow that down into bringing into more banking, and within banking we can slightly narrow it down further to lending, right? How AI will shape the lending as an industry today, right, is a thought that we can have a conversation on, especially what steps are you taking currently, and what are your focus areas going forward. That certain processes definitely AI will do really well. Certain processes we think we have a bit more time to go, where more of the work, the way it's happening, is probably better to be handled in a similar fashion.
See, this is a very fast evolving space. So let me give you a couple of examples. Now, today, when someone has to analyze a balance sheet, I mean, someone will make a note of all the ratios, do all that. Now, today there are systems or capabilities available in the market when you just punch in, or you tell you program a system to pull the balance sheet or a P&L from a central source. They could analyze it within a couple of minutes throughout all the variables, which can help in decision making. So you may not want them to take the decision on what you want to lend or no, but at least all the critical decision factors are listed out, all the ratios are listed out. Therefore, something which a person used to take 1 hour to do is happening in a matter of couple of minutes. And there's no physical flow of paper. You collect a balance sheet from a customer, bring it. It's all just pulled from the source. Similar thing with the IT returns, etc. of individuals. So all that is happening. Now the next, and again, call center is a very strong use case where bots are now answering all the queries, etc. So now the next phase I would say is that, which is something of great interest, is that you have a lot of customers whom there are a set of customers who you do not want to lend. Certain set of customers are in the middle where you are unable to take a decision. Certain set of customers you decide to lend. Now, this whole segment of customers which is in the middle, is there a way where you have a dynamic scorecard where you have an algorithm running which tells you that, okay, so this customer at this price point fits into your kind of a risk return equation which you want to do? So is that something possible? I think it is possible, just requires some more time, research to be done, but all that is likely to certainly happen. So where your ability, for example, if today you source 100 files and approve 35 files, suddenly you may find that you can approve not 35, you can approve another 30 odd at a price point which makes sense for both the customer as well as the financial institutions. So that will happen. A lot of stuff in terms of being able to collect efficiently, trace customers who've gone missing, use of APIs to pull data from some central government record to be able to understand where the vehicle is plying or where did it last pay toll, etc. So all those are a lot of stuff which is happening, which is in the motion, and as and when it gets developed, I think it'll certainly take you to a different scale, and your ability to lend more at lower cost and collect well is a great win-win situation to be in. So this is one set of example, but many such things are all in play, and in my view is you try 10 things, 3 will work, but those 3 will give you a disproportionate advantage if you are the first one to do that. So that's how we are looking at the developments around us.
Correct. Now, the concept of power law, where you try 100 and probably one gives you the return of equivalent to 1,000 and pays off all the 100 also, is happening in AI also. Right? Is happening in AI. I'll share one of the places where we at Yubi see very fast adoption of AI is the funnel intelligence. I mean, our day job is to handle multiple different partnerships, right? Partnerships will have a partner and a lender on the both side, and the funnel getting orchestrated digitally. The funnel breaks somewhere or the middle, and it's a part of a business. The funnel can break because a customer dropped off or various other reasons. Reactivating that funnel was a job of understanding the RCA, diagnosing the RCA, working on the RCA. Sometimes the RCA required a call to the customer, getting the funnel restarted and back on track. The best stat in this was 48 hours. Now with the AI being able to analyze the logs to see what the RCA is, to be able to see what the RCA needs to be, call the customer, get the customer resolution done and restart the funnel. Now it has become a 5 minutes job.
Wow,
right.
That's massive.
And that is because the multiple hops of different departments and processes it required for this funnel to restart. All of that AI has taken over and said to be able to handle and orchestrate some of that. So the concept of power law continues to be there in AI. You spoke about collections, right? How AI is getting utilized in collections, and collections being one of the key focus areas, starting from pre-due, early warning, all the way to collect, right? What are your thoughts about the way we collect some of the digital loans and some of the new age loans that we are distributing in the market today? Is there a change in collection strategy around them, or is there something new way to be able to look at how collections are getting handled as we move along?
No, as we see the ticket sizes reduce and the margins compress, which is happening secularly in the industry, the ability to collect well at lower cost is an imperative. So that's where when we implemented these multiple scorecards across the collection stages, we are seeing a great uplift along with cost control. So earlier, if a customer responded only to a field visit, you don't have to wait for a call to happen and then allocate it to field for 15 days. You straight away send someone in the field to do that. Or through pre-due date management, if you call him, if you send a message and he reminds him to pay, he pays. or even the ability of the system to suggest that this customer is a good prospect for settling a loan. Because in his bureau he has other defaults and there are multiple financiers borrowing him, so this is the right time to offer him a settlement. That makes all these are helping in a big way to be able to collect well at a lower cost and improve your NCLs and therefore improve your bottom line and asset quality.
Looking forward, right? If we have to scale responsible retail credit further, right? Any specific thing that you specifically want to focus on, and probably what we haven't spoken thus far, right? Anything that comes to your mind that this is strategically important for industry and for the bank and for everybody to pivot towards what we have not been doing thus far, but it is paramount important to be able to look at, do it.
So I think the flip side of all the digitization is also the IT security. I think you have to be absolutely clear and investing a lot in this and staying ahead of the curve in this, because if technology makes decision making faster, etc., anything going wrong could also mean a larger price to pay. At the same time, a lot of focus on governance. I think the regulator has done a tremendous job thus far of managing all the banks, etc. So I think that is they're calling for heightened regulation. The customer data protection, etc., has become extremely important. So you'll have to keep an eye on maintaining very high governance standards. And I do see also a move to get more and more customer consent for anything you want to do with the data on the customer side. So that these things are increasingly becoming popular, and at some point in time we've seen in some of the developed markets for the banks, the banks have been forced to share data with other banks. The democratization of data is something which will happen, so it won't be a situation where because you have data of a customer you have a great advantage. At any point in time, customer will decide who has his data and who could access his data. So all these developments one has to be very watchful of going forward.
Yeah, and if you add that, so rightly pointed out, we have never been in a DPDP era before. That is standing in front of us to be compliant.
Yeah.
Right? We have never been in an AI era before. That's also standing in front of us to make most of it. Merging both of them and making it advantageous for us and for the customer is going to be a challenge for all of us to be able to help solve and help crack through that. How DPDP AI, and if you also have the baseline regulatory compliances to be there, which is by default de facto, how do we make sure that this house is so strongly advantageous for all of us?
Absolutely.
And the ecosystem is going to be the game for 2026 and onwards.
Absolutely true. And banks by nature have legacy IT systems. It's not easy to change. Therefore, it'll be easier to plug on something. So therefore, the ability to have a system which can draw from various sources, that'll be great.
One final advice to young bankers or young fintech players who are probably starting the careers today. Let's split this question in two parts. Individuals starting their careers today in the banking, and companies, fintech, starting their businesses today, right, in this space. What advice will you give them so that they can learn from some of the learnings that you may have?
See, I think the common underpinnings remain that keep focusing on the customer, keep identifying the gaps you see what is happening in the market. I think for organizations it's extremely important to see how you fill these gaps, how you enable some of the larger institutions to reach out to the last mile of customers, and always keep an eye on governance. Technology is paramount. At the same time, IT security also is paramount, and you always have should have a use case that by when will you start breaking even. And for individuals, I would say that keep focusing on the customer, and there are no shortcuts. Don't take any shortcuts. I mean, you have to just ensure that what you're doing is right in spirit, right in terms of governance, in terms of ethics, in terms of customer interest, etc. So keep those in mind. I think that will keep you in good stead.
Thank you so much for joining us today, Sumit. It was my pleasure talking to you. Right, lot of valuable share insights that I'm personally going to take back, especially the triangle, margin, volume, and risk. You manage that. You manage any form of credit that you are doing. Thank you so much for your time today. I love the conversation.
Thanks. I really enjoyed and look forward to more such conversations.
Happy to have you.
Thank you.